All right, I guess we're live right now. Hello, everybody, and welcome to the webinar. I'm Sandeep. The webinar's theme is Bear Proof Your Investments with ETPs, and it is brought to you by Leverage Shares, the leading issuer of ETPs or exchange products or exchange traded products, as better known. Before we jump into the webinar, let's take a few moments so that all of you can settle down, pick up a pen and paper if you want, or open up a Word document. There'll be a Q&A session after the webinar, so you guys can type in your questions right now if you in the course of the webinar, and we will handle all the questions at the end. There's a possibility that I will have answered some of your questions in the later portion of the webinar anyways. But leave no questions unasked is my policy on this. So here's a little bit of a background on the subject matter. Exchange traded instruments as a whole are a subset of a larger universe of products known as structured products. Structured products have a long and varied history. They're extremely complex. They vary in complexity, they vary in style, they vary in focus, they vary in coverage, and the vast majority of them are available only to sophisticated investors. The term sophisticated investors is pretty much a regulatory requirement. It is meant to show a difference between regular investors who buy, let us say, stocks versus people who buy these kinds of products, because you need to spend some time and energy and resources into understanding the product also. Exchange traded instruments, as I mentioned, are one of these structured products, and they're typically linked to an index that delivers makes a theoretical return, and the exchange traded instrument tries to follow that return. A quick history about ETFs. They originally started out as index-linked mutual funds all the way back in 1973 by Wells Fargo and American National Bank, if I remember correctly. And in 1975, it was brought to the public markets by a gentleman known as John Bogle. John Bogle started an index-linked mutual fund to the S&P 500 on December 31st, 1975. John Bogle, incidentally, was the founder of the Vanguard Group, and before he passed away, this index-linked mutual fund became an ETF known as the Vanguard 500 Fund, and had about $441 billion in AUM in 2019. So it's a long history of structured products here, which was specifically meant for the public. So one of the first ETFs that came out in the 90s, pure ETFs, not mutual funds that became ETFs, or pure ETFs, was by State Street Global Advisors. Note the name, we'll reference this a little bit later. State Street launched an ETF called the S&P 500 Trust ETF, also known as SPDR, or affectionately referred to as SPIDER, in 1993. As of the end of 2021, I think it had $400 billion in assets. So right now, the S&P 500 is down significantly, so it's no longer $400 billion. Since then, of course, it's a big. Exchange traded products are massive. Exchange traded instruments have evolved into all kinds of things such as ETNs, ETFs, and ETPs, and ETCs. ETN is an exchange traded note, ETC is an exchange traded commodity, and ETP is an exchange traded product. Now, the terminology is a little bit different and difficult, and they tend to get used interchangeably. So it's a little bit complicated. So let's try out. Let's proceed. So that's me looking really cool. I like it. My name is Sandeep Rao. I lead research here at Leverage Shares. A quick disclosure, the value of an investment in ETPs may go down as well as up, and past performance is not a reliable indicator of future performance. Trading ETPs may not be suitable for all types of investors as they carry a high degree of risk. You may lose all of your initial investment depending on market conditions. Only speculate with money you can afford to lose. So also take into account changes in exchange rates and so on and so forth, as well as tax laws, because exchange traded funds in many places have specific tax benefits. So refer to people. So If in doubt, refer to an expert for more advice on these matters. And of course, take a look at the risk factors we mentioned in the prospectus if you're trying to buy any of these products. Broadly, we will cover three sections. We're going to compare various exchange-traded instruments. We're going to talk about ETP features, and we're going to outline some ETP plays. We have over 180 different products, so you can do any number of plays on this, depending on what you want to do. So we're going to cover some of them. Obviously, we're not going to cover all of them. And of course, they're historical plays. No current plays. We're an issuer. We don't play with ETFs, ETPs. We offer it to our customers, and they can do whatever they want with it. So let's go into pure presentation mode so that your view is unobstructed. And let's talk about the differences between the various ETIs, as I'm calling it for now, exchange-traded instruments. So let's start with some typical differentiators between the exchange-traded instruments. ETFs are typically designed around a large basket of stocks or bonds. ETCs, exchange-traded commodities, are designed around commodities such as metals, energy, livestock, orange juice, milk, all kinds of things. Gold, oil, of course. Exchange-traded notes are essentially a type of bond that pays the return of the index it tracks. And ETPs are built around smaller baskets. Even a single ticker has special features such as leverage or short exposure, etc., etc., etc. Now, the flow diagram on the right sort of highlights the confusions that I mentioned earlier that we see especially in the media when it comes to ETPs. All ETFs, ETCs, and ETNs can be considered to be ETPs. However, not every ETP can be classified exclusively as an ETF, ETC, or ETN. When they can't be, they're simply referenced as ETPs. For example, we reference our products as ETPs. Popular media sometimes makes this mistake and refers to ETFs and ETPs interchangeably. They're not technically wrong. As you can see in the flow diagram, they're technically right. But when it comes to investors reading through this, they sometimes don't understand that an ETP, if someone like leverage shares is selling an ETP, it is not the same as an ETF. They are different kinds of instruments. So let's take a look at a few differences in ownership patterns and terminologies. ETFs are supposed to own the securities in the index they're tracking. ETCs are considered debt instruments. Thus, commodities tracked by the ETC are held as collateral. In that, collateral is, we're going to talk about collateral a little bit in the future, in a subsequent slide, but this is an important difference. ETFs and ETCs are somewhat similar in that there is some ownership holding or ownership interest, if you will, by the issuer, so that the investors can have certain level of returns. ETNs, on the other hand, are also considered debt instruments, but don't provide ownership of the securities. It's essentially you're believing in the worthiness of the issuer, the credit worthiness of the issuer in being able to build these kinds of products and maintain these kinds of products. So let's consider the implications of rules and designations on exchange-traded instruments now. Were it not for the fact that ETNs don't have to own the underlying assets, rules would be a little blurry between ETFs and ETNs. In the US, typically at least 20 distinct tickers are needed for an instrument to be termed an ETF. At least 10 distinct tickers are needed for an instrument to be termed an ETN. As per the European regulatory framework UCITS, which stands for Undertakings for the Collective Investment in Transferable Securities, if my memory serves correctly, there is a 20-35 ratio rule applied for ETFs. That means each constituent must have a weight below 20% of the total weight of all the tickers in the ETF, but under exceptional circumstances, one single constituent weight can go up to 35%. If this ratio rule is applied correctly, the instrument is termed a collective investment vehicle. Otherwise, it's termed a debt instrument. Quick note, ETCs, ETNs, and ETPs are universally termed debt instruments at the present under current UCITS framework. So there's an interesting byproduct of the UCITS standards, that is the risk categorization. Note when I refer to SPIDER, the SPIDER ETF, the State Street SPDR ETF that was launched in 1993 and is probably one of the most enduring products in the market today. SPIDER is ranked 6 out of 7 on the riskiness factor under UCITS, whereas our own product, which is a 3x daily leveraged long US S&P 500 ETP, has a rating of 7 out of 7, which is extremely risky and relative to the ETF, which is only 6 out of 7. We have 1 point difference between the S&P 500 ETF and the S&P 500 ETP, which is quite interesting. So we did mention collateralization earlier, so let's talk about it a little bit. And this has an interesting ramification on commodity ETFs versus ETCs, because there are commodity ETFs which are not like ETCs. A commodity ETF directly holds the physical commodities. That is, the issuer actually owns the commodities underlying the ETF. And ETC is collateralized. That is, the money paid for the ETC by investors is used to purchase the exposure from a party that guarantees the physical commodity. This is known as a swap exposure, and the party with the commodity is called a swap provider. So when we consider all of this put together, you also have to remember that many inverse, leveraged and leveraged inverse. Now, inverse means a minus 1x, leveraged means plus 2x, plus 3x, and so forth. And leveraged inverse is minus 2x, minus 3x, and so forth. These kinds of ETFs, most of them are actually ETNs and are not true ETFs. There have been some ETFs that have provided a 2x or a minus 2x exposure, but they typically don't go any further than that. The swap agreement, the swap exposure that I mentioned earlier, is a standard system for creating ETNs, ETCs, and even many ETPs. This creates an ever-present swap risk exposure to the investor. That is, the swap provider might not be able to deliver the exposure in adverse market conditions, and the issuer will be left with no alternatives but to sort of pass on the risk to you. There is really no way of fixing this problem. So let's take a broader view of the differences between these various instruments that we just discussed. One thing that all of these instruments have is that you don't need a margin account to trade any of these instruments, ETF, ETC, ETN, or an ETP. Losses are always limited to initial investment, so that means there is no drawdown on your margin accounts, and they are traded on your exchange. On an exchange, so the pricing on any point of time is actually pretty transparent. ETNs and ETPs are required to track multiples. ETFs and ETCs are required to track multiple tickers, stocks, commodities. So even if you have a commodity ETF, there has to be at least 2 different types of commodity, which is, for example, if you're saying corn, you have to have 2 grades of corn inside the ETC. There is a definite diversification requirement for ETFs, which does not exist in any of these other instruments, and only ETF is UCITS compliant. None of these other instruments will be considered as UCITS compliant. They're all considered as debt instruments. Now, I discussed collateralization. So ETFs and ETCs have to be collateralized. ETPs are also required to be collateralized. ETNs are not required to be collateralized. Now, the last thing that I'm seeing here is the ring fence structure. Ring fencing is an interesting byproduct of UCITS regulation. It essentially means that the issuer's assets and the ETFs and the exchange traded instruments assets have to be kept separate. Therefore, if the issuer goes bankrupt, let us say, the creditors cannot claim the ETF as for payments of loans that they have made to the ETF issuer. Now, note that there's an asterisk here. When it comes to ETPs, this is not a hard requirement for everybody. However, we implement a ring fence structure. For example, we are not required to do it, but we do it. You'll also notice here in the previous slide that I have made an asterisk next to this next to the point for ETPs up there in the Venn diagram, that we don't lend the underlying assets. Again, we don't lend the underlying assets because we don't use swaps. And we'll talk about that in a little bit. So if we are not lending, we are actually physically holding it. And again, we're going to return to the question about swaps versus physical holdings in a little bit, but keep that in mind. These are two interesting aspects that differentiates leverage shares products versus other ETP issuers. Again, we don't have to do this as per regulations, but we do it for the security of our investors. Other ETP issuers are not required to do it. So again, caveat emptor or buyer beware has been the byword for the stock exchange since 1604 when the Amsterdam Stock Exchange opened. So just keep this in mind if you're making investments in these kinds of products. Reading the risk document is very, very important. Let's talk about the marketplace for exchange traded products. As you can see here in the marketplace, 2022 until the end of July has been a very, very, very rewarding year for leverage, inverse products. Over 1,100 products are out there right now being traded by investors all over the world. And estimated AUM is around $110 billion. In terms of geographical distribution, we see that Europe and Asia are basically the champions in issuing new exchange traded products. By the way, this image that you're seeing in front of you is extracted from a service known as ETF Global Intelligence. And you can see some of the things I mentioned about using ETFs and ETPs interchangeably. They essentially lumped ETFs and ETPs together in the number of issuances. As in an ETP issuer, we would probably disagree with this. We would say an ETF is very distinct from an ETP. But anyways, the Global Intelligence ETF GI, as it's known as, has mentioned over and over again that over the past several years, Asia Pacific plus ex-Japan plus Europe leads in ETP and ETF issuances. You can also see by product structure, AUM is around 15% of total AUM held in exchange traded instruments in general. And as of July, when you look at the final image here, which is the average daily trade volume, this is a very interesting, I thought this was a very interesting graphic. It's basically an even split. Leveraged exposure, leveraged volume is 50%. And if you add up leverage inverse and inverse, it's another 50%, basically. It's nearly 50%. So the market is pretty evenly split because of the fact that ETPs are short-term traded instruments. So let's jump right into ETP features and discuss some salient features that are quite important and quite interesting to look at. Let's first talk about the problem with swaps. Now, as I mentioned earlier, ETNs, ETCs, and many ETP issuers use swaps. More specifically, they use a particular type of swap called a total return swap to finance their positions. What these swaps allow is that a party can take up a huge position while posting limited funds upfront by sort of taking a loan from somebody who owns a lot of assets. So the person who is lending it or the institution that is lending it is called the swap provider. Therefore, the party effectively controls more of an asset or assets than its cash reserves would have permitted. Total return swaps have been very controversial, especially when it comes to publicly traded instruments. Warren Buffett in 2003, in a letter to his shareholders, called total return swaps and derivatives like it financial weapons of mass destruction. He's saying they're carrying dangers that, while they're latent right now, are potentially very, very lethal. And this was sort of proven last year. A very good example from last year was when a hedge fund known as Archegos, run by one Mr. Bill Huang. I see a number of Korean investors in this chat. So maybe Bill Huang, the name Bill Huang rings a bell in your minds. Was that he was a poster child for prosperity by his own standards, by his own efforts. Emigrated from South Korea into the US long time ago in the early 80s, built himself up all the way through by going to premier business schools and premier universities, working for some of the best hedge funds and asset managers in the world before starting his own asset management firm known as Archegos. Now, Here is basically how a total return swap works. Since I mentioned Archegos, let's call it a hedge fund versus a bank. The swap provider is the bank, and the party is the hedge fund. The investment bank essentially buys the assets, a basket of stocks, for example, like a basket of stocks, and makes payments to the hedge fund based on the total return of the assets. The bank owns the assets, not the hedge fund. So while a hedge fund has heavy exposure to a stock through swaps, it isn't subject to disclosure laws, in the US at least. Laws vary all over the world, but typically this disclosure factor is fairly standard across the world. So if the underlying assets falter, the hedge fund must pay the bank an amount based on the negative returns, plus the regular fees. With heavily leveraged positions, the bank will make a margin call, saying that essentially the hedge fund has to put up more collateral. If the client fails to comply, the bank essentially sells the assets, and it triggers a greater decline in prices. It triggers more margin calls. It triggers more sales, so on and so forth. This is what happened to Archegos, and it ended up costing all the banks approximately $20 billion, I think, in calculated up to April 2021. Almost every major bank was hit except for Goldman Sachs, which didn't really like Bill Hwang very much and said that we're not going to invest, we're not going to give you a lot of collateral, we're not going to give you a lot of leverage, as they call it, but ultimately decided to give a little bit of leverage to him. Mr. Hwang's company, Archegos, was predominantly invested in three major companies. One of them was Viacom CBS. Viacom slipped 9% on a single day when it announced its streaming service, and that was enough for an entire sort of domino effect on his holdings, on Archegos's holdings, because most of Archegos's holdings were being done through swaps. He has essentially Archegos had like a 2.2 to 2.5% leveraged exposure to a variety of assets, and basically in 2 days, $20 billion was lost. Mr. Hwang allegedly, the case is still ongoing. Mr. Hwang allegedly pledged the same set of stocks to a variety of banks and then leveraged them all to the hilt, which is why he's facing a securities fraud case in the US right now. The case is still pending and it's still ongoing, so we're not sure if this is what really happened, but essentially that is the allegation made. On the other hand, happily enough for us here at Leverage Shares, we don't build our products based on swaps. Assets underlying each ETP are physically held in a special purpose vehicle or SPV. Essentially, you can think of the ETP as being the equivalent of a share of a publicly traded company, but with one difference. The special purpose vehicle is open-ended. That is, more units of ETPs can be created based on investor demand. Essentially, we have eliminated swap risk for the investor altogether. So in times of market downturn, this is an important consideration. It is completely up to the investor to decide if this is a deciding factor between purchasing, let us say, leverage shares ETP versus any other issuers ETPs. But this is already built in, and we are unlikely to change this at any time in the future. Entering a swap agreement has another problem. It carries with it a significant amount of risk, which the swap provider charges a number of different fees for. Typically, a large portion of this is passed on to the investor in terms of fees baked into the product. So basically, because of the way we hold our assets, we are able to maintain a lower fee structure, and we are able to pass on greater returns because its returns minus fees is the final price. Greater returns to our investors. On average, barring promotional fee holidays, leverage shares ETPs tend to be cheaper than their counterparts. The difference in dollar terms might be minor because the fees are actually quite low. But basically, my personal argument here is there's money on the table. It's free for the taking, so take it. So let's discuss another aspect, which is daily compounding. Reflexively, you can probably imagine that borrowing a leverage exposure sounds very simple. It's available. It can be done quite easily. It's a relative. It sounds cheap, and if you have a strong conviction, it can possibly be done quite easily. However, manually maintaining a constant inter-day daily leverage factor requires effort, computation, and resources, which a retail investor might not have. A leverage position that isn't compounded daily versus a position that is compounded daily has some very interesting effects. Take a look at the graphic on the right-hand side. For example, we are showing you what happens when an underlying asset on a short position, a minus 1x versus a minus 1x short ETP. What happens to it when the underlying asset goes up by 63% over a course of 10 days? The short ETP loses 40% in value, but short 1x short made by an investor loses 63% in value. It's identical to the upside, right? So it is minus 63 for a short, but because of the fact that we have daily compounding, the minus 1x short's loss is only 40%. So let's take a look at a few scenarios. Let's consider scenario 1, which is up 2% every day. Let's consider it over a series of days, 5 days, let us say. Every day, the underlying goes up by 2%. The math is relatively simple here. If you have a 3x position without a daily compounding, and if you have a 3x leveraged ETP in play at the same time, you can see from day 3 onwards the spread between these two, the spread in gains between these two kinds of instruments or positions keeps on widening. Let's consider a second scenario. Up 3% one day, down 3% the next day. If you do that, you realize that the leveraged ETP, take a look at the bottom part of the screen relative to D0, where you see that the 3x leverage ETP actually does not do as well as a 3x position without daily compounding. By day 5, for example, a day 3x non-compounded position has 8.4% in gains, but a 3x leverage ETP has only 7.2% in gains. So there's an interesting question here. Do you see the gap between in the bottom part, the gap between the 3x, the two kinds of 3x's? It's around 0.6 on day 3 and it's about 1.2 on day 5. So for a 3x factor, let's consider another scenario then. Up 3% one day, down 3% the next day, a lower leverage factor, a 2x. Let's see what happens here. On day 3, the gap is around 0.2%. And on day 5, the gap is 0.4%. Again, the 2x non-compounded position did pretty well in this kind of market scenario when the stock is going, when the underlying is going up and down on a pretty even-handed basis. But look at the difference between the two leverage factors. The gap has decreased. So we can come up with a nice catchy catchphrase for this. And surprise, surprise, we have. Essentially, when it comes to ETPs, the trend is your friend. Leverage ETPs plus 2x plus 3x, etc. pay off when the underlying steadily trends upwards. So now, so let's at the same time, let us see what happens. As I mentioned, the same image from last time, a plus 63% rise on the underlying asset versus a minus 1x short ETP does better. So leverage ETPs sort of magnify this effect on the upside and give you better returns when the underlying is trending upwards. Inverse ETPs pay off when the underlying steadily trends downwards. Again, the underlying asset has fallen by 40% in the graph that you're seeing. The minus 1x short has given you 40% gains, but a minus 1x short ETP with the daily compounding feature gives you 63%. When it comes to when the underlying is choppy around a mean with no trend, a lower leverage factor has a better risk payoff structure, which you can sort of see in this graph that we're showing here. Again, we're talking about a minus 1x. Again, we're talking about a minus 1x, but you can see what's happening here. When there's a sort of trend of a choppy trend here, minus 1x doesn't do very well either because daily compounding hits you again when the mean reversion happens. So trends are your friends. If it's going up or going down as it is doing right now in present market conditions, it's a fantastic time to purchase, to supplement your portfolio with ETPs. So let's come to, let's call it a loss prevention mechanism. Let's come and discuss a loss prevention mechanism which we call the airbag mechanism. Capturing the trend is a lucrative proposition, but a heavy intraday movement could magnify losses in the blink of an eye. Some of you might have seen this with certain stocks where there's a precipitous fall within an intraday and maybe a recovery, or maybe sometimes trading gets halted and then everything has to start, trading has to start all over again after a gap in the trading session. This doesn't happen very often, but these kinds of days are a major headache for investors. So in theory, a 3x leverage product could become worthless instantaneously if the underlying stock lost more than 1/3 of its value during the trading session relative to the previous day. But this doesn't happen. Why? Because of an airbag mechanism. As I mentioned earlier, ETPs, exchange traded instruments, generally inherit their characteristics from an index. We are no different. We inherit certain characteristics from single stock leverage indexes provided by the likes of iStocks and others. And they have a certain leverage, they have a certain airbag mechanism, or as they call it, a trigger value attached. Essentially, what happens from a trigger value is that if just look at the long leverages right now, leverage instruments, plus 2x, plus 3x, plus and so forth. For a plus 2x, the trigger value is minus 25%. Let's just keep this in mind. For a 3x, it is minus 16.67%. For minus 1x, it is 50%. What this means is that when a stock has fallen by that much relative to that index, there is a reset mechanism that kicks off. So let's look at a few scenarios. Let's consider a hypothetical stock traded in the New York Stock Exchange with a previous day close of $350 and a 3x ETP initially set at $100. The stock experiences a decline in price during the day and it finishes 32.67% down from its previous close. A 3x ETP without the airbag mechanism would lose about 98% of its value. But with the airbag, it's a different story. Oh, I'm sorry, I did not skip through. Oh, okay. So this is what happens. $350. Yes, $350 stock from $350. It has gone down by 32.67%. Here's what happens. The ETP is rebased at 11:30 since the underlying had fallen by 16.67% in this scenario by 11:50 and reset with the rest of the session treated as a brand new day. Another reset happens at 1:30 p.m. when the stock drops 16.67% relative to the price at the first reset. And the third reset happens at 4 p.m. and the 3x ETP is reset again. End result, instead of losing 98% of your value, you're losing 68% of your value. I won't say this is a great scenario, but it's better than losing 98%. Let's look at another scenario. It's called a V-shaped rebound. Again, let's consider a hypothetical stock with a previous day close of $350 and a 3x ETP set at $100. The stock declines by 16.67% by 11:30. However, the stock gradually climbs back and closes plus 0.5% relative to the previous day. A 3x ETP without the airbag mechanism would have added 1.5% in value. Remember, it is day on day. So if the stock closed 0.5% over the next day, the 3x ETP should have increased by 1.5%. So unfortunately, in this case, the airbag kind of hurts you. Without the airbag, it is you would have been up 1.5%, but because of the way you reset and the gradual climb back up, you're actually losing 25% of your value relative to what you had previously closed at. So that when the airbag is so one thing you can understand from this is that when the airbag is triggered, the effects are path dependent. First thing, if the underlying stock moves up after the intraday rebalance, the ETP may lose more than a leveraged product without an airbag. If the underlying stock, on the other hand, continues going down after the rebalance is triggered, the ETP may lose less than a leveraged product without an airbag. If the decline is severe, the airbag may even prevent the ETP from crashing intraday and becoming completely worthless. And since I only discussed 3x and 2x, please note that the same protection exists on the inverse leverage products as well. The resets are backwards. For example, it is plus 16.67 for a minus 3x, plus 25% for a 2x, minus 2x, so on and so forth. The airbag mechanism is conceived purely to protect downward risk in the ETP's trajectory on an intraday basis. All said and done, the airbag is basically an important form of insurance for the investor. Again, it doesn't get you back all the money you might have lost from the downward trade, from a downtrend during the intraday process, intraday trading session. But you save a little bit of money. You save a bit of loss, essentially. It can be argued that empirically, a severe decline followed by a hard rebound is less likely than an outright decline. You can argue that. There's certainly statisticians out there who have calculated this, and they have said that the latter is more likely than the former. Yes, that is true, possibly true. But again, regardless of empirical evidence, it bears remembering that the insurance pays off at the worst of times. At other times, it's basically a cost. It is a protection mechanism designed for the worst case scenario. If the stock recovers, there's always another day to play. Now, since I mentioned play, let's talk about some ETP plays. So there are two ways broadly that you can talk about where you can how you can use ETPs. You can treat it as an opportunity or a hedge. The opportunity or the hedge. One way of using this opportunity or hedge is by understanding the fact that there is a relationship between the ETP and the underlying. ETPs can be the instruments to capitalize on short-term opportunities in the underlying. Instead of using futures options at all, ETPs can hedge the value of existing stock holdings. So let's look at a few cases of opportunities now. For example, in the first 2 weeks of Q2 2020, for 10 trading days, from the 1st till the 15th of April, Amazon's stock price rose 15%. In comparison, the 2x Amazon ETP gained 45%, while the 3x Amazon ETP gained 72%. Opportunity. How about something on the decline? And again, I'm using the minus 1x. During the predicted and expected downturn at the start of Q4 2020, Amazon stock price fell 10% in the first 8 days of September. In comparison, the minus 1x ETP gained around 11%. So again, you see a little bit of the effect of daily compounding here. The stock fell 10%, but the minus 1x ETP gained 11%, which is pretty good. You basically got 1% for free. By the way, guys, I'm using actual reported closing prices for each day to show these positions. These examples that I'm showing are actual examples from actual end of day prices. So let's talk about a hedge then. And let's use everybody's favorite EV company, Tesla. Let's assume an investor has $8 million in 6,667 Tesla stocks as of the 3rd of January this year. The stock market has been going through a jagged downturn for some time. the investor buys $2 million in the -3x ETP, which is called TS3S, on the same day, January 3rd, to hedge for market condition. TS3S is only worth around 0.02% of the stock's price. So this basically amounts to about 7.6 million ETPs. Over the course of the next 8 days, the stock goes on to slide nearly 8%, but the portfolio value, take a look. The portfolio value has changed by only 0.1%. Do you see it? Yeah. So total portfolio value comprising of the stock and the -3x short component, if you combine them together, is basically the loss over the next 8 days, wherein the Tesla stock price fell by 8%. On the other hand, your total Tesla portfolio value is down by only 0.1%. Again, end of day prices used. So let's try something else. Tactically hedging Tesla stock holdings with both the 3x Tesla ETP, which is TSL3, and TS3S, which is the -3x ETP. The former accumulates value during upswings, while the latter does the same during downswings. But before that, a disclaimer, since we're an ETP issuer, we aren't qualified to offer investment advice. While we can offer market commentary and instrument performance statistics, this is not supposed to be construed as investment advice. Investors must recognize the risks in making market investments and seek out an appropriate professional if they need investment advice. So let's consider a sum of $10 million this time that needs to be invested in Tesla, that must be invested in Tesla, one shape or way or form. Stocks, absolutely required, and then some protection. The base case would be the outright purchase of 8,334 stocks as of the closing price on January 3rd of this year. The alternative would be an 80-20 split, such that you can reserve $2 million for ETP purchases in either leverage factor. This $2 million is not topped up or drawn down at any time. In the event of a sale of the ETPs, the proceeds are used to purchase the next batch of ETPs. The remaining $8 million is used to purchase 6,667 Tesla stocks on January 3rd. Only one ETP factor is held at any time for the purposes of this exercise. Only one ETP factor is held at any time. So either the TS3S is held or the TSL3. Let's try a little bit. Let's have some fun here and do a little bit of a rule-based investment strategy. I'm absolutely blind. I have no preference. I will buy TS3S or TSL3 depending on market conditions, and I'm going to make some rules up. Two trigger points are established. The upper bound trigger is calculated at 106% of the price at any day, while the lower bound trigger is calculated at 94% of the price at any time. We established two 4-day rules. The first one is the factor decision of the day, to buy plus 3x or minus 3x, which sees that if the day's price has breached either trigger over the relative to the price seen 2 days ago, if the upper bound is breached, the factor decision is buy plus 3x. If the lower bound is breached, the decision is buy minus 3x. In all other events, no decision is made. We basically continue to hold. The second is the holding decision, whether to continue holding a position in the ETP or not. So we do a counter and we count the number of days the present day's price exceeds that of the previous day. Secondly, the holding decision is determined by this counter. Over the course of 3 days, including the present day and after the day of the last ETP purchase, if the counter is greater than 2, a short ETP position would be liquidated. Alternatively, if this counter is less than 2, a long ETP position would be liquidated. If neither, the ETP portfolio continues to be held, as I said. This rule-based strategy is run from the 3rd of January till the 29th of March. Again, historical, this portfolio was not run. This is a pure simulation based on actual end-of-day prices. This is basically what the rule-based strategy tells you. What I described is essentially the flow chart or an algorithm for a rule-based automated trading strategy, or a semi-automated trading strategy, if you will. And this is what happens. Number of TSL3s are purchased, a number of TS3s are purchased and liquidated and then used to purchase TSL3s. TSL3s are liquidated and purchased for TS3S, etc., etc., etc. All the prices indicated are the end of day prices, by the way. Again, we use only end of day prices, not intraday prices. And as we see, the stock only portfolio, the base case that we had of 8,334 Tesla stocks that was worth $10 million is down to 91.6% of its value as of the end of March 29th. Meanwhile, the rules-driven strategy is down to only 99.1% of its starting value. So essentially, even by using a blind investment strategy, which is absolutely not conviction-driven but as a rule-based strategy, there is a case to be made that it can be used tactically to sort of buffer the price volatility in the stocks, in the underlying stock. There are many types of plays that are possible without considering the relationship between the underlying and the ETP. One such idea is a simple tactical short duration play on sectors versus leaders using ETP. Again, we have all these ETPs and you're welcome to take a look at them. For example, you can do NASDAQ 100 versus Apple, China Tech versus Alibaba, US Oil versus Shell or BP, so on and so forth. It's not necessary that one arm is a hedge for the other arm. Many variations are possible depending on market conditions and investor discretion. So the choice of play is up to you. The choice of holdings is up to you. The choice of duration is up to you. Market makers will ensure that there is sufficient liquidity for you to trade these instruments. And as you have seen in trends as of July, as of end of July this year, this market is continually expanding, and there is a lot of upward potential for you guys to consider using ETPs as a satellite portfolio to your core portfolio to buffer the core portfolio's downturn in these current times. Essentially, this is how you bear-proof your investments in stocks. So, in conclusion, ETPs can be stand-ins for futures and options in terms of hedges. Unlike the latter, ETPs don't need margin balances. Unlike futures and options, that is. Leverage plays have become safer with ETPs. Potential losses are limited to invested amount only and doesn't need top up in margins. Also, remember we talked about the airbag, right? So the airbag is also one type of protection. Issuer fees are minimal, transparent, and baked into the quoted prices on your trading screen. And if you have any questions on fees, we are required by regulations to disclose to you what the fees are, and we do so on our website, in our disclosure documents, in everything, in various places on our website and on key identification documents also. The consideration of swap risk, especially when it comes to hedging, would likely be of interest for veteran investors, because veteran investors would realize that downturns make swaps more risky. Leverage plays have been around Asia and Europe for decades now. The only difference is that they used to be played over the counter in a private transaction space. And what the ETPs have done has brought some of these strategies out from the private marketplace into the public marketplace. As I mentioned at the start of, as I mentioned in the course of this webinar, we do post market commentary very regularly. We make videos very regularly, or will be making videos very regularly, and we are pretty much available at throughout social media. Do find us on YouTube, LinkedIn, Twitter, Instagram, and even Telegram. If you want to contact us with any questions, there's my email address. It's srao@leverageshares.com. If you want to talk to the company's representatives in any way, shape, or form to discuss any issues you might have with ETPs or any opportunities you might see with our ETPs, or any comments, any questions, feel free to email us at info@leverageshares.com.